Moving on to the next piece of the puzzle, our next speaker is James Mwangi, who is the Chief Executive Officer of a company called Equity Bank in Kenya. If you're not familiar with it, you should really look forward to this because it's a fantastic story, and I very much look forward to his comments. James, over to you.
Royal Highness, Secretary of State, ladies and gentlemen, it's a real pleasure to be here today, and I want to declare that from the onset, I'm a champion of financial inclusion. If nothing else, I hope what I will achieve is to really persuade you to really take this as an agenda for all of us. Because when you get 2 billion people excluded from financial inclusion, it then means that they are denied the opportunity needed to realize their dreams. Financial systems allocate resources. So if you are not being allocated resources, then it means you are condemned to your status, which normally is poverty. And the challenges. I've been asked to give a little bit about the challenges and the success as a use case of Equity Bank. Equity Bank started about 35 years ago. After 10 years, it was declared technically insolvent and was condemned for closure. It was number 66 out of 66 financial institutions in Kenya, and it had distinguished itself by having accumulated the highest losses of that period. It had started with a capital base of 1 million Kenya shillings, but it had accumulated losses of 33 million shillings, technically insolvent to 32. The funny thing, the total assets were only 22 million. So how they balanced the books, I didn't know. So that's where the story starts. And essentially, this was the era of microcredit. That's when everybody was pushing Grameen, BRAC, and all the others we knew. And Equity made one just simple differentiation from microcredit. It chose to be a microfinance institution, offering the whole range of financial savings, payments, processing, savings, insurance, and all the rest, such that realization that the poor people need the whole set of financial tools, not just one tool. That gave us a significant opportunity of differentiation and to become a one-stop shop for financial services for the poor. The second aspect was recognition that by that time, only 4% of Kenyans had bank accounts. And so banks were not in the marketplace. They were niche players. The market was 96%. And then there were niche players at 4%. So Equity chose not to compete with the banks, but chose to compete with who was providing financial services to those who were excluded. Research reflected that people were keeping their money under the mattress. And so our competitors' analysis was not about banks or financial institutions. It was about the mattress. And suddenly, we realized why the mattress was more competitive than the banks. It was not charging fees. That was one of the things. It had no minimum balance. It was accepting whatever a person had. The third one was that it was availing liquidity while needed. But banks were restricting withdraw on two aspects, frequency and amount. If you wanted more than a certain amount, you had to give 7 days notice. And you could only access your money once. So these are the tools that we did. So in our model of banking, we removed minimum balance. We said you open an account even when you don't have anything. If you have an expectation or a dream of ever getting something, we'll give you an account. The second thing, you could withdraw the maximum you had, but we could also offer you, in case you came and you found your money had not come to the bank or had not been credited, we could allow you a little bit of credit to be able to travel back home. So minimum balance went to negative, build on trust. The third thing, we removed the ledger fee, because poor people could not understand how they keep their money in the bank and somebody keeps on withdrawing through ledger fee. and standing orders as we all knew them. So we abolished all that. And then we removed the frequency. We allowed people to withdraw as many times as they could, and limitation of how much you could withdraw. So that was literally changing the model of the bank. But more importantly was we changed equity from a commercial mindset to a social movement mindset. And that was more on the corporate philosophies. We created that the bank's essence or purpose was socioeconomic transformation. It was not bottom line, was not balance sheet, was not profit. And essentially, this became the cycle of the staff, that they were not being measured by how much money they made, or it was how many lives they helped to transform, how many tools they availed to the population to use as tools for socioeconomic transformation, and how much they brought champions. And that is why my first cause was to appeal to you to become also champions of this. And of course, the vision was modern financial services. The poor deserve quality above all. It's not just the products, but quality. And of course, then we had to provide one distinction from banks. We had to listen, to understand, with an objective of understanding. And that helped us a lot to develop the products the poor required. And then the only currency we had, because we were technically insolvent and they were poor, is trust between us. They didn't look at balance sheet, so we were not to look at their poverty, because we were equally poor. So that has helped. So those corporate philosophies helped us to be who we are today. And then we said, to be able to serve the poor, we had to be humble and down to earth. So if you look at our values, corporate values, they have nothing to do with the banking, other than professionalism and integrity. The other one is purely the social aspect of humanity. Is respect for one another, dignity for your customers, creativity, teamwork with your customers. And essentially, we didn't become a bank. We became a social movement. And if you look at equity customers, never say they are customers. They say they are members. Members of a movement of socioeconomic transformation. The psyche of the people is how many members they are able to bring and how many members are empowered. And basically, eventually, we have evolved to become really a one-stop insurance, everything all put together to serve very strong governance structures. This is where maybe I would say the biggest source of our success is corporate governance, so that leader became the agent that guided. And of course, and that was phase one, as we saw, remove financial barriers. And if we remove financial barriers, we saw in just 10 years, we had moved 21 times in terms of number of customers, and our deposits had grown 30 times within a short period. The second phase was more of democratizing financial access. And this then we started in one way or another bridging the last mile. We realized that it was not the charges that we had waived for the customers that mattered. It was the cost of access to banking. The public transport cost to cover 200 kilometers from where they live to where the branch is located. That was the real cost. It was the real cost of spending 2 days to access the bank. So we decided to take banking services to the people. The first phase was just mobile banking on 4 wheels. We got a Land Rover, equipped it properly, and every day it went to the villages and served the people in the villages. So every village knew which particular day of the week the bank would come. So you saved them the 2 days of travel and the public transport cost. And essentially that made banking affordable. It was not the banking charges. It's the cost of accessing the bank that was really the biggest barrier that we overcame. Then eventually we realized that that was becoming very challenging because we were not giving them liquidity other than once in a week, and needs didn't know that the day that we were to come. So then we introduced agency banking. We realized that shopkeepers always traditionally has played the role of custodian of people's poor money. They keep their money with them because they trust them most. 2, shopkeepers give credit and people pay when they... So we hear, shopkeepers do banking. We decided to formalize that and we made them agents. Today, we have 46,000 agents distributed in every village of the country. That solved 2 things. There is no distance, there is no cost, and banking was demystified. It was sold like salt and sugar. And for those who smoke, cigarettes. So there is no real issue about a banker in a suit using acronyms in banking. It's all really like ordinary thing. And people were familiar with it, so we just formalized it. The second thing, the shopkeeper was very excited because we brought human traffic or footprint to his shop. So as they withdraw, they buy from his shop. So it is not how much commission we paid them, it's how much we mobilized the whole village to come to their shop. And so they did cross-selling. So they say, don't even pay me, but please give me agency. So essentially, but we also said, we'll pay you as an incentive. So they also earned commission. Most of them, they earn more from commission than the amount of money. And the customer is very excited. The bank has come to the village and is sold to him and served by the same villager. They don't have to dress up. They don't have to take a bath because they are going to a bank. Once they come from the farm, they withdraw their money or deposit. And trust is somebody you know. It's not that mysterious banker in a red tie. So that brought us a lot of... And then phase 3 was realization that phase 2, we started competing with the banks. Here, we were disrupted by telecoms. Telecoms came and simplified banking. What they did, they didn't give financial services. They gave convenience. And that is the biggest challenge the world has to contend with. Telecoms don't offer financial services. They offer money transfer. They don't complement and compete with the banks. They compete with Western Union and MoneyGram because they transfer money. Financial services is savings, it's loans, it's insurance, it's money transfer, it's payments. So what did we do? We accepted telecom and called it financial inclusion. We did disintermediation. Those who understand Kenya, because Kenya is very successful with telecoms, savings to GDP climbed down from 28 to 24 to 18 to now 12%. So you are successful in convenience, but you kill savings. Development is not about credit, it's about savings. It's savings that power investments. Until a nation, a population has the discipline of savings, then it can't invest. So we have completely disintermediated. It's equity saw that threat, and simply what it did was to apply for an MVNO license. So we got a license and then decided we'll use telecom as a channel, not as a financial service provider. So it became a channel, and we give each of our customers a SIM card. That was when it was only feature phones that are available. Now with the smartphone, we do develop app for them, and then they have the freedom to use whichever phone that they have. And that has basically transformed the bank. And that is really, the good thing is then we moved to variable cost, and the bank moved away from brick and mortar. Quickly, these are the tools. We don't any longer call them products. Why? Because then we digitized all the products, and these became the tools to access the whole range of banking products. So they are more of appropriate. So for ordinary people, it is SDK and or USSD or the app. For individuals aware of, it's personal internet banking. For corporates, it's cash and liquidity corporate banking tools. Then you're able to get the whole. Now, we can see what has happened to the channels. Look at it, mobile took over, and 97% of all our transactions are now on the mobile. And as you can see, jointly here, we can declare the death of the branch. the branch is now only as an advisory center, not a transaction center. Why cash has been digitized? Once you remove cash in the equation and allow digital payments, then the branch ceases to be a transaction. And we can see the tools. Look at the agents and look at the branches in terms of numbers and how that has been done. This is the most conventional, the work of agents. The gray is withdrawals and the orange is deposits. So you can see people have accepted digital currency. The agents are now bridges of converting cash into digital money. And once it becomes digital money, then people use electronic payment or digital payment. And so it mobilizes money more. And we can see the payment tools. Once you start now digital payments, the biggest challenge is to digitize retail commerce. And we can see once, then this is fintech capability. And the convenience of telecoms are brought and money transfer. Essentially, Equity controls 60% of all merchant banking in Kenya and 70% of all diaspora banking. Well, you have 46 banks in the country. And we can see most of the bulk of the transactions have been digitized. And so these are now more of converting ourselves to a fintech as opposed to a bank. So payment gateways and APIs. So you expose the APIs. So what we have is a platform, and we expose the APIs, and people do whatever they want to do with the capabilities of the bank. So we are no longer providing products, we are providing capability of the bank, and you customize that to your infrastructure. And we can see what is happening at the level. Let me try and close because of time. What has been the impact? What has been the impact? 13.5 million people from the 2,000 we started with have now access to banking services. They have savings, they have... Now, products, we didn't call them current accounts. What we realized the poor people was transactional accounts. They could not afford the cost of a current account, but they needed an account that allowed them to transact. So we created transactional accounts. Instead of savings, we just created accounts that received their money and removed all the charges. And essentially, we can see then it in terms of loans. If you look, it's the same curve for loans and deposits. Why are we stagnating? Because of challenges of regulation. The government said, no, can we cap interest rate? They capped interest rate at 13%, and sovereign risk rate is 14%. The private sector is expected to borrow lower than government. And essentially, we had the inversion immediately. And we can see the total assets. From the $300,000 we are talking about, we are now above $6 billion US. The poor can save, and the poor can borrow. And we can see the shareholder. From the technically insolvent bank, we now have $1 billion and a market cap of $2 billion. What have we become? The biggest bank in East and Central Africa. $50 million bigger than the next bank in Nairobi Stock Exchange. So and we can see what happens in terms of trade. We were growing tenfold every 5 years, sustained for 20 years. Keep on mopping. And we can see the numbers. The value that was created, because these are poor, we created enormous value. We have now replicated the model across the region. And partnership, championing the cause. We now process social payments for the donors for free. And we have partnered with them because we have realized you need to go beyond financial products for the poor. We have learned from NGOs, create capacity. So you can see the financial literacy. We have trained 20% of the total entire youth population in Kenya. We have reached to the children of the poor, and the rest and the rest. And the rest is, as we can see, is history. My time is over, but the microfinance institution is now ranked the 11th largest, best bank on earth in return on assets, and 35th most globally solid bank in the world. And that is the market cap in the stock exchange, now the #1 bank.
Hang on. No, we have a few more minutes.
Yes, thank you.
We have a few more minutes.
Thank you.
I think the applause speaks for itself. I don't think I need to comment much on the presentation and the story. We're in an unusual position. We're ahead of time.
Okay, thank you.
So I'm not quite sure what to do. And I think what we'll do is just to pick up on a couple of things. I'll tell you what I love about the Equity Bank story is that it's all true. That's what I love about it. It's true. Commercial lending to Africa's unbanked, the bottom of the pyramid. Don't underestimate the significance of that statement. What I hate about the Equity Bank story is that it still stands in isolation. It's hard to think of another example across Africa's 54 countries that has been able to replicate this model in a meaningful way. Now, we've seen you're expanding. What would you put that down to? It should be the model for Africa.
Thank you very much. Two challenges with the equity model. As we saw earlier, it is powered by passion and enthusiasm for doing good in society. It is not profit motivated. It is about socio-economic transformation. No bank has been able to replicate that vision. A vision-driven, a purpose-driven organization. The second thing is that equity inspired a lot the corporate banks to come, and we had a lot about downscaling. And in Kenya, almost every bank then opened branches in containers to compete with equity. But they never changed the organizational culture. Where people strain is changing the organizational culture. When you come from corporate and you think you are downscaling, you need to downscale the way you treat people. For the poor, what they really require most before you give them your financial product is dignity and respect and honor. That's what they really require most. They want to be treated with dignity. But if the mindset of your staff is still that you value customers based on the size of their deposit, or the way we measure customers, how much money do we make on that customer, and value customers based on amount of money you make from it, all the banks tend to fail because of that.
Some food for thought for the corporate bankers in the room, perhaps. Very quickly, what about regulation? Because that seems to be a real cap, literally and figuratively.
I think also we must give it to the Central Bank of Kenya. They were trying to solve a problem of inclusion. And so they became partners. If you read a book written by Professor Gerhard Kotz, the title of the book is Understanding the Rebirth of Equity, from Technical Insolvency to What Equity is Today. They recognize the third success factor of transformation was accommodation by the Central Bank of Kenya. Essentially, the biggest challenge was compliance. The regulation is written in such a way that for you to be allowed to open a bank account, you have to have a utility bill. You have to have an address. But the address in Africa is a hill. I live in this. That's not recognized in registration as an appropriate address. Or next to the fig tree. So essentially, that issue of eligibility, what is normally known as KYC, know your customer, that needs to be abolished. And basically in Kenya, what we did, we were a bit bold and audacious. We looked at the act, not what it allowed, but what it disallowed. So we said the Banking Act doesn't disallow this. So anything that was not disallowed, we assumed was allowed. The mindset. So we did the things. Like when we were challenged, why are you opening accounts without introductions? We said because we have taken the ID cards and we think the Kenya government knows its citizens. So we refused to take introductions, and because people had this national identification, we said that was sufficient. The government knows its citizens. Because there was no way in a village where there is nobody with an account, you get an introducer. It was an egg-chicken position. So we decided to open and then deal with the consequences. The consequences was accommodation. Yeah. So we pushed the limits of regulation. Yeah. The second thing is things like, if we go, because we are operating in DRC, you find members of parliament get very excited and get a registration that says you can't charge for ATM, you can't charge for withdrawals, you can't charge for agency. And then suddenly the bank says, how do you maintain this infrastructure? It must be done commercially for it to be scalable. Unless it's scalable. So there must be that accommodation. Or you come like Kenya and say, we cap interest rate, maximum is equal to sovereign risk. Then the banks really price risk. So there's no pricing of risk in Kenya. So what you do is you exclude anybody whose risk is higher than sovereign.
Would you like to see more equity banks across Africa?
Absolutely. That's why I attend every conference and give out. So you get this presentation from the organizers.
So you need to track this man down. And you need to speak to him throughout the day. James, thank you very much.
But jointly, we can also replicate it. Thank you.